As we're all aware, REITs have been doing pretty terribly in the market right now, and they have been for the past couple of months. If we look at the S&P 500 United States REIT Index, you can see it's down roughly 12% in less than 2 months. That's pretty disappointing considering REITs were doing really well between April and November of last year. And this downward trend has expanded across every REIT sector that exists: data centers, retail, industrial, and everything in between. With late 2024 and now 2025 already appearing to be rough for this dividend-rich sector, in this video we'll figure out why REITs are struggling so hard right now and what we can expect in the new year. Let's first compare real estate to every other major sector in the market. Sector Spider ETFs is a company that manages 11 sector-specific funds, which, as you can see, according to their website, they have a fund for utilities, technology, healthcare, and real estate among others. Comparing all of them will give us a pretty good idea as to how real estate is doing in comparison to every other major sector. Using the sector tracker on their website, we can see that real estate has been the second worst performing sector in the entire stock market over the past 365 days. They barely beat out healthcare, which has been the worst. But they've been trailing materials, consumer staples, utilities, and basically a lot of other boring types of companies. So what explains this crazy underperformance? It's important that we zoom out for a moment because what's going on in this asset class isn't unique. This downturn we're seeing with REITs isn't just going on with REITs. This downturn is something that's happening across the entire real estate sector. A lot of home builders have been doing pretty poorly, including Pulte Group, Toll Brothers, and Meritage Homes Corporation, which have all done bad since November. It's also being experienced in the real estate services sector. That would include companies that provide brokerage services, home listing services, and transactional management. As you can probably imagine, it's also expanded to mortgage REITs. These companies either invest in pools of mortgages or they issue their own mortgages, and it's been very hard for these businesses for a while. Conditions in this sector have actually been very hard for a number of years, but the past couple months have made things even harder for them. The iShares Mortgage REIT ETF, REM, is down over 50% in the last 5 years. MREITs aren't included in the Spider Real Estate ETF, which if they were, would make things even worse. But adding to the confusion, in the past few weeks we've been treated to some really good economic news, which has only added confusion as to why REITs are still struggling. Studies have shown that prices on consumer goods have been cooling off and that recently the consumer price index has slowed down. And yet despite this good news that's been coming out, REITs are still down along with the rest of the real estate sector. Ultimately, the biggest reason REITs are down so hard has to do with the market being pessimistic about interest rates. And the key driver is, of course, inflation. Heading into 2024, the market was a lot more optimistic that the Feds were going to be more aggressive in cutting interest rates. However, given the fact that inflation has been so sticky, Jerome Powell has said that they don't anticipate cutting rates as aggressively as they first indicated. The real estate sector as a whole, which would include REITs, is a cyclical industry. They can have very long periods, anywhere from a few months to a few years, where they underperform the market. And then other years they can outperform the market depending on economic conditions. The reason REITs have been struggling is because of the inverse relationship that exists between interest rates and REITs themselves. When interest rates are high, it negatively impacts these companies, and even harder than some other types of companies. The primary way REITs expand their property portfolios is by borrowing money. They also have the option of issuing new shares of their stock to raise money, which many do regularly, but it's better to do this when share prices are higher for them. When interest rates are high, borrowing money becomes more expensive. That makes acquiring more properties less profitable, and many REITs slow down on expansion when interest rates are high. Some rely more heavily on issuing new stock, which does save them money compared to taking out debt, but when a company issues new shares of their stock, it ultimately lowers their share prices because every investor now owns a smaller amount of the pie. And then, of course, when interest rates are high, it adds pressure to the businesses that are occupying these REITs buildings. It's impacted some sectors more than others. For example, a lot of office REITs have been obliterated over the past couple of years. But even though the numbers that REITs are reporting in general are still very good, which we'll take a look at in a moment, the market is still choosing to be pessimistic with REITs. It now appears that the Federal Reserve isn't going to be as interested in cutting rates aggressively in 2025, which could lead to continued underperformance for this asset class. That's going to be really important for this asset class's recovery. Donald Trump, who assumes office very soon, has said that he does want interest rates to be cut significantly. However, when it comes to borrowing money, there's a lot of other factors at play when it comes to determining how much interest is going to be. We have been seeing that with mortgages. Over the past year, the Feds have been cutting interest rates, and yet the 30-year mortgage rate just rose above 7%. In the meantime, some REITs have been facing increased pressure, particularly with some notable stores going out of business. That's put some additional pressure on retail REITs that have been leasing to these tenants, and it's something that'll need to be monitored as time goes on. So given how long interest rates have been high and the market hasn't liked these companies for a while, how have REITs actually been doing? Are they really struggling? As of their most recent reporting, these are the current dividend payout ratios for all of the REIT dividend aristocrats. Realty Income is reporting a payout ratio of 75.4%, and this is their AFFO payout. For Federal Realty Trust, it's 64.3%, and Triple N is at 69% AFFO. It's commonly accepted that anything between 70 and 80% is considered to be a conservative payout ratio for a REIT. So given the fact that some of the biggest names in the REIT industry all have safe or extremely safe payouts, especially with Triple N and FRT, that's a really good sign. Over the past 2 or 3 months, I could only find one announcement regarding a dividend cut among the 225 plus publicly traded REITs that exist. It happened with a company called Service Properties Trust, a very small hotel REIT that's been experiencing headwinds for a while. Odds are you've never heard of this company, and for good reason. But this is the only REIT in the past 2 or 3 months that I could find that had to cut their dividend, and they operate in a very tough sector, hotels, which I generally suggest people avoid. So ultimately, the biggest reason REITs are down so much is because the market is less optimistic about interest rate cuts, and active investors in the market have been choosing to dump them to chase better performing sectors. Price movements in the market are largely due to financial institutions and active investors who are seeking the hottest trends in the market. And while interest rates are still high, a lot of investors have chosen not to invest in these REITs. But the really great news is that if you're not a day trader or a financial institution and you're instead looking to earn a large amount of passive income through dividends, then REITs are currently presenting a really excellent opportunity. Many companies in this sector are offering some really outstanding dividend yields that you don't normally see from these stocks. Both Realty Income and Triple N REIT are currently offering yields close to 6%. It's normal for these companies to offer yields around 3 to 4%, so you're getting a lot more money for your investment buck. And remember, although they might not yield as much as other investment classes, they're still really good at growing their dividends long term. Most closed-end funds and covered call funds don't offer the same growth consistency that REITs do. I say this because I know the majority of my subscribers prefer the ultra-high yielding stuff like covered call funds and business development companies, but it's still really important to hold things in your portfolio that offer you long-term dividend growth. If you're a long-term investor, which is what I encourage everyone to be, now is a good time to buy up these investments. These companies are continuing to grow despite higher interest rates, and eventually their share prices will catch up to their increased size. If it's your goal to live off dividends, stop worrying about their share prices. You only need to be concerned about their dividend payout ratios, which again, most REITs are still doing great. Better times will eventually come, they always do. Now is a great time to buy up these largely discounted stocks and get even more dividend income. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.